Well, I had a great conversation with a client recently about the current state of the stock market and the economy. And it led me to produce this video because I think some of the conversation was instructive for all of us when it comes to our portfolios, and particularly for clients who are near retirement or recently retired. And of course, one of the dilemmas for many retirees is, how do I invest my hard-earned money to try to preserve it while at the same time getting enough yield or total return to reach my retirement goals? And for many of us, it means having money in the stock market. So I want to cover a couple of things. One really good resource that illustrates historically what happens to the market. And I think there's some peace of mind around seeing that information. But then I'm going to talk about some basic principles that I've talked about on this channel a few times to try to give us some peace of mind and confidence as we take a look at our portfolios and our retirement income plans. How do we structure our portfolios during times of uncertainty? There will always be times of uncertainty, and yet we still have to make decisions about our accounts. And so I want to talk about that in the context of this video. So I'll talk about the resource, but again, if you're new to our channel, make sure you hit subscribe so you don't miss future content. We're producing all the time on all aspects of retirement income planning. And as well, if you like this video, make sure you click like. Okay, so first thing I'll do is I just want to show you a chart that is a really good illustration of what happens to the markets long term. So you can see here we've got the S&P 500 index total returns from 1926 to 2024. And you can see that the mountain charts here in the light kind of green is when the markets were doing well. They were in a bull market phase. And then, of course, the dark color is the bear market phases. Now, what's interesting over this whole time period is we had 19 bull markets covering about 1,006 months, and we had 18 bear markets covering about 177 months. So as we talked about in the channel before, we've got way more up days than down days. And of course, the up market cycles are far greater than the down market. Now, if you look at each of the cycles in this chart, the definitions were essentially a bear market's a fall of at least 20% from the previous peak, ranging from minus 21% to minus 80% across an average length of about 10 months. That's the bear market cycles. On the upside, there were 19 bull markets, as I mentioned, and had gains of at least 20% from the previous trough. By the way, if you'd like to get a free download of this chart, just go to the show notes. There's a link you can click. You can download it to your device. It's a great chart to have on hand, particularly when the markets aren't doing well. And they average 53 months in length, and advances range from 21% to the positive to 936% to the positive. So when bull and bear markets are viewed together, it's clear, obviously, on this chart that equities have rewarded disciplined investors. So the key issue is trying to initiate and act on that discipline. And obviously, we've had a few videos recently where we talked about the absolute core importance of systematic rebalancing and trying to have the discipline. If you're an equity investor, you don't want to get involved in market timing decisions. And even more importantly, if you have systematic rebalancing and you're buying on these dips, you're more often than not going to be well rewarded for those dips. We always think this time is different. It usually is not. And if you can muster up the discipline to add to your core equity portfolio during times of uncertainty, that's a good discipline to initiate. Now, that doesn't mean that it's easy to go through these particular cycles. So there's one point that I'd make that's very important. If you look historically, not everyone's going to have all their money in the U.S. stock market. So the first takeaway from this chart, obviously, is the importance of geographic diversification. So I think it's really important that clients structure their portfolio so they have, whether you're in Canada, U.S., and global investments, move your investments into different geographic regions. You do not know which region is going to give you the best performance in any given year, so geographic diversification on the stock side is important. But just as important is having diversification around asset classes. So you don't want to have everything in the U.S. stock markets. You want geographic diversification on stocks. You also want to have fixed income, some cash equivalents in your portfolio. And what will drive those decisions will be your risk temperament. And more specifically, if you're getting close to retirement or retired, what do you need from your portfolio to fund your cash flow needs? That's really, really critical. So for most people, they're not going to go through this kind of volatility if they have a mix of cash, fixed income, or bonds, geographic diversification on their stocks. And very important is to try to own the broad market. So don't make timing calls around, do I have small cap, big cap, mid cap? Do I go with just dividend paying stocks? How do I structure my portfolio? Own the broad market through broad market, all equity ETFs. So you don't have to get the timing decisions right about which sector is going to drive performance. It's often very concentrated returns from very specific stocks and sectors. You're not going to get that one right on a consistent basis. So own the broad market so that whenever market drives the performance over time, you'll participate in that part of the market. Okay, so let me just link this conversation back to the conversation I had with the client. So she was very concerned about, what do I do now with my portfolio? She's actually had very good performance in her portfolio over the last number of years. She's seen a little bit of a decline in portfolio value the last couple of months. And I said to her, you're never going to get that sort of market timing decision right. What you want to do is go back to first principles. You're about to retire. Go back to the retirement income plan. The retirement income plan, in very granular detail, has outlined what you need to be taking from each bucket in your particular situation to generate the cash flow that you want. Don't be aggressive with that part of the portfolio. That's the piece that you need to de-risk. Do that today. Make sure you de-risk so that you've got those assets set aside for cash flow, just in case the market goes through some short-term volatility. So you want to do that planning. That's really the key issue here, is if you've got a plan in place, that's going to give you huge peace of mind about how to structure your portfolio during times of uncertainty. Obviously, over time, markets are up more than they're down, but you don't know when they're going to be down. So your plan will define for you how to position different parts of your portfolio to defend against that market risk. And that gets back to a concept we've talked about many times on this channel, which is timeline investing. If you'd like to get clarity on that, just make sure you go to the show notes. There's a link back to our homepage. You can find out more about our retirement planning services. And you can also set up a complimentary call to have your questions answered on that program and service that we offer. Anyway, all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.